Welcome to the Three Edge Week in Review for the week of September 27th. I'm Fritz Folts, Chief Investment Strategist, and with me here today once again is Steve Cucchiaro, President and Chief Investment Officer at Three Edge Asset Management. Today, along with a brief update of the global capital markets, Steve and I will be discussing the Federal Reserve and whether, as the Fed begins to prepare to unwind their extraordinary monetary policy measures, their job may be about to get more difficult, putting Fed policy between a rock and a hard place. Before we get to that, take a quick look at recent activity in the markets. Thursday of this week marked the end of the month of September and the end of the third quarter. And here in the US, the S&P 500 finished the month of September down by approximately 5%, which was the worst month for the S&P since the onset of the global pandemic in March of last year. And in the bond market, investors are facing the potential for 2021 to be possibly the worst year of performance for bonds in more than 2 decades, particularly after a sell-off triggered by comments last month from Fed Chair Powell that the Fed could start scaling back its bond buying programs in November. In fact, the Bloomberg Global Aggregate Bond Index lost almost 2% in September and is now down over 4% so far this year, and that marks the biggest decline for the first 3 quarters of a calendar year since 1999. Investors are also concerned about rising inflation. The price of oil recently reached $80 a barrel. Food prices have increased over 30% over the past year. And meanwhile, on Friday, the Commerce Department reported that the PCE, the Personal Consumption Expenditure Price Gauge, which Steve is going to discuss later, which is what the Fed uses or incorporates into its inflation targeting, rose the most on an annual basis in 3 decades. And while no doubt some inflationary pressure will prove to be transitory, inflation may not be going away for a while. And there's also fear that the surge in inflation may be coinciding with a slowdown in economic growth. So Steve, let's get into it now. And after 14 years of accommodative central bank policy, which obviously was supercharged in response to the pandemic, we may be at the brink of the long-awaited beginning of the unwinding of the Fed's extraordinary monetary policy. And so, as we ask in the title, is the Fed's job about to become much more difficult? And if so, why?
So the Fed has 2 mandates from Congress. One is to promote low and stable inflation. The second is to promote full employment. And since we've had many, many years of low inflation, it's allowed them to focus all of their energy and all of their policy on supporting the economy. But their tools are blunt. They create reserves. Some people call that printing money. And they use those reserves that they do with a click of a mouse. They create them out of thin air, and they use those reserves to buy marketable securities with the hopes that that helps the markets, and then that in turn will help the economy. But what's happened is very little of that money went into the real economy at first. Most of it went into asset price inflation, and then that was followed by producer price inflation, consumer price inflation, et cetera. So now we're in a situation where producer price inflation, the last reading was 8.3%, consumer price inflation 5.4%, and as you mentioned, core personal consumption expenditure index, which is what the Fed spends most time looking at, excluding food and energy, up 3.6%. So we say now the Fed is between a rock and a hard place because their choices are, with inflation no longer benign, either they need to accelerate their tightening program, but that could put the markets and the economy at risk, or they need to keep accommodative to help support the economy and the markets, but then they could lose credibility with inflation, and inflation expectations could rise, and that could cause a bigger problem down the road.
All right, so let's talk a little bit more about interest rates and bond yields. We've clearly seen the yield on the 10-year U.S. Treasury, rise actually fairly sharply recently, particularly after the September FOMC meeting. And we know that interest rates can rise for different reasons. So perhaps if you could explain why we're seeing this increase in interest rates and bond yields recently, and what this could mean for the global markets going forward.
So Treasury bond yields are related to two things. They're related to economic growth, and they're also related to inflation. For example, when there's a recovery after a long recession where bond yields are typically very low, once the economy starts to recover, there's more demand for money, and you see bond yields rise in a healthy way. However, bond yields also respond to rising inflationary fears. And typically over the very long term, you look back over the last century or more, investors buying bonds have typically required a risk premium or a rate of return 2.25% over and above the inflation rate, just to account for the fact that they want to make a real return more than just keeping up with inflation. And there's always a risk inflation could go up. Today, bond yields are more than 2% below the lowest of those inflation measures that I mentioned, the core CPI. This is a very much out of balance. And this is the kind of environment that we haven't seen in decades, but you go back to the 1970s for the last time we saw that. So what we can say is that the environment is typically more risky now for stocks and bonds, but more conducive for real assets and cash.
Excellent. Great. Very good. Very much helps us understand what we've seen, particularly in the last, month in the markets and interest rates and bond yields. So I think it's safe to say that it could be an interesting and perhaps volatile final 3 months of the year. So that'll do it for Steve and me. Next week, Eric Beagleisen and I will be presenting our 3-Edge View from the Edge, which is our review of our current outlook for the global capital markets as we head into the final 3 months of 2021. And then Steve and I will be back the following week with another edition of the 3-Edge Week in Review. Remember, all of our videos are available on our YouTube channel, as well as on our website at 3edgeam.com. And so until next time, on behalf of Steve and everyone at 3Edge, thank you for listening.